Hello and welcome to Switzer TV Investing. I'm Peter Switzer. This goes out on Monday nights on our own YouTube channel. Just go to Switzer Financial Group, make sure you become a subscriber and press the like button. Now on tonight's show, Michael McCarthy of CMC Markets and Julia Lee of Burman Invest look at two dud stocks for 2019, Speedcast and Reliance Worldwide, which I asked the question, will they be goers this year? They were pretty good in 2018, but as I say, 2019, they had absolute shockers. Paul Rickard looks at JB Hi-Fi. It reported today really well. This is a company that Paul and I liked around $23. It's now over $40. But the question is it still a buy? Paul will answer that question. Next, Michael Wayne of Medallion Financial will look at his hot stocks for 2020. Michael's a very good stock picker, worth listening to. And finally, the founder of Centuria Capital, John McBain, tells us why this property business has done so well. A very interesting interview. That's the show, and without any further ado, let's cross to Michael McCarthy and Julia Lee. Thanks for joining us, guys. All right, so look, I do want to know what stocks you like, as I always do every week, but I also put the test to you to look at two stocks that people are always asking me about. One is Speedcast, which was, way I remember, a darling in 2018, had a shocker in 2019, and I was looking at the theory around the dogs of the Dow. Now, of course, these aren't blue chip stocks, but the dogs of the Dow can often work for blue chippers, have a shocker of a year, and then you buy them after that, and that next year after they do better because their price is down, they're good dividend payers, and because the price is low, you get a pretty good yield. That's the theory of it, but these aren't those sorts of stocks. Maybe Reliance one day might be, but Speedcast, Reliance, let's start with you first, Julia.
Look, I definitely prefer Reliance Worldwide. Yeah. I think one of the things that we found globally is that the US housing market is doing really well, and that's supportive for companies like Reliance. My favourite pick in that space would probably be James Hardie, because Reliance also has exposure to the UK, which isn't doing so well with its Brexit. Yeah. But certainly Reliance has some tailwinds in terms of the US, and stocks like James Hardie is probably my top pick in that space. And other building material companies as well, like CSR. I think these building material...
Boral went to the US, and it hasn't been a great story.
Down 11% trading today after admitting that some employees in the US Windows business were manipulating the numbers.
So accounting fraud. So Boral wouldn't be the pick there. James Hardie definitely, and CSR I like as well.
Okay. Michael?
Speedcast, Peter, I was a fan. I've said so publicly. I bought in at $1.80. Thankfully, I didn't pay the $6 it was trading at previously, but I bought in on a value argument. At $1.02, I averaged in, a very dangerous practice, I should point out, but when I did, I set myself a line in the sand at 90 cents. When the stock breached that, I cut the position. I'm thanking my lucky stars today, given that the stock's in suspension and it looks very bad. The CEO has resigned. The guidance is out by at least 10%. And the new numbers are bolstered by a number of one-off cost reductions and asset sales. So this business is a lot worse than I thought, and I think than some in the market thought. It's one the short sellers have definitely got right. It's still one of the most shorted stocks on the market, and it looks like they're going to win on this one.
Has there been misrepresentation to the market, do you think?
Oh, well, the problem here is this company is worth, what, 200 mil, maybe less now in terms of market capitalisation, yet it's got $600 million in debt. So the debt's a real problem when your business is cascading in this downward spiral. And so the banking covenants, I suspect, would be a problem. So in this case, either a renegotiation in terms of the debt, otherwise a massive diluted capital raising, both which are pretty bad scenarios.
And they bought lots of businesses. You'd think that the individual businesses, if you sold them individually, might add up to being more what the market's valuing. Would that be a fair call? Because the fact that it went to $6 and they were acquiring businesses, you would have thought that there was some value in these businesses they were picking up.
Well, you'd have to pay back the $600 million first.
Yes, that's part of the exercise.
But the acquisitions are at the heart of the short sellers' argument here. They've argued they paid too much, that they've been poorly integrated, and the accounting treatment of them hasn't been correct. That's been the thesis for a long time now. It looks like we'll get more light on those issues when Speedcast does seek to be reinvented.
On Reliance, it has already made a bit of a comeback. is there?
It's right back.
Is there more?
In May last year, it warned and guided EBITDA lower.
Yeah.
It dropped from 460 down to touch lows below 320.
And that's when we started talking about and
Exactly.
saying,
And now we're back very close to $4.60 ahead of the result later this month. So if they confirm in that result what the share price is telling us, it's, there could be further gains for Reliance.
I got to talk to you about JB Hi-Fi. Is Richard Murray one of the best CEOs? He's done well, hasn't he?
If he had a moustache, he'd be twirling it.
That's right. Exactly right. So, but $44, that's a pretty high.
46.09 today, Peter.
Okay.
46.09.
Well, I liked it at 23 because I couldn't believe.
I was with you.
Yeah.
But I was out in the mid-30s.
Yeah,
It
well,
started to look rich to me.
yeah.
But the numbers they've delivered today are extraordinary. 5% sales in the Australian operation, 6.5% profit growth. So not only are they beating the pants off the competition, they're actually getting better margins as well. That's an extraordinary performance.
Yeah, now he's not, but you are uber cool compared to you. Do you shop at JB Hi-Fi?
Yes, I do. I mean, this
You
is
got
my
JB
pick.
Hi-Fi, you're all over you.
JB Hi-Fi was one of my picks a few months ago. Look, I think JB Hi-Fi is going to continue to do well. The other stock that I like that's hit an all-time record high today is Credit Corp. CSL continues to power along, as does Macquarie Group. So look, you know, this is a
And
great
has
market.
Jerry picked up a benefit today, Harvey Norman, with JB Hi-Fi doing so well?
I think so. I think the retailers are really starting to see some traction. So both JB Hi-Fi as well as Harvey Norman. But JB Hi-Fi is one that does have a habit of beating the market on the upside when it comes to reporting season. I guess because we've been talking about some of these building product type of companies, can I introduce a new idea? One
Of
that I'm
course.
watching this reporting season, given that Boral's had such a poor performance today, and some of the read-through from Boral's performance was around the Australian market, that perhaps we could see short-term weakness in terms of some of its competitors. So the company that I'm watching very carefully is Adelaide Brighton.
Yeah.
I think that it could potentially miss this reporting season, but I think if it misses, it's definitely an opportunity to pick up this stock. I think we're going to see tailwinds coming through from the housing market, which has stabilised, the bushfire
Council approvals are
rebuilding, infrastructure projects, and not only that, the Burrow Group, the Burrow family owns 43%, so a potential takeover there if we do see significant weakness. So look, I think if we do see a miss for Adelaide Brighton, I'd be looking to pick up some of that
Naka,
stock.
any other stocks that you're liking at the moment?
Well, a couple of others, and one of the things I've been thinking about this week, Peter, is how some elements of the market are performing really well despite the worries. And I'm thinking about some of those small cap stocks that have trebled or quadrupled in the last few weeks because they have exposure to the coronavirus. And I'm also thinking about put options, Peter. The market has defied so much of the doom and gloom so repeatedly, but it's been hard for investors to get on board. And I cut some numbers today. An investor can, if they have an index portfolio, and nobody does, but in a theoretical index portfolio, you can protect 95% of the value until June with just 1.7% of the value. So if investors want to stay in the market and take advantage of potential further gains, and yet still sleep very soundly at night, spending 1.7% of the portfolio
So let's
seems
imagine
reasonable.
someone's got $1 million in their portfolio. What's it going to cost them for this insurance? Give me
$17,000.
Okay, $17,000. And if you lose it, can you claim it as a tax?
Oh,
deduction
absolutely. It's part
in
of
your
your
self-managed super
It's
fund?
part of your overall portfolio return. Depends how tax is treated. And I'm not a tax advisor, but yes, I certainly do.
Okay.
It's incorporated in my trading results.
Do you think a lot of people just don't understand options and therefore they just don't simply do them?
The problem is the maths underlying a lot of these derivatives is complex.
Yeah.
But you don't need to know that maths to use them sensibly. And what a lot of people don't understand is you can use options to reduce your overall market risk. Now, if you only buy options, all you can lose is what you spend on those options. So in the case of our theoretical $1 million portfolio, the most you could lose on those put options is $17,000. That's if you buy them. If you sell options, it's a whole other story, and you must have a much higher understanding. But for every investor, if you can add, subtract and calculate a percentage return, you can use options effectively.
Do you use options, Julia?
Yeah, I'm an accredited level 2 derivatives
Why
advisor.
am I surprised?
But look, the reason you buy puts is for risk management. So the bigger thing is probably risk management,
Yeah.
and you can do that through buying
Particularly
puts.
after you've made a really big gain on the market. I guess
Yes,
is one
and
thing.
also through diversification or even different investment styles.
Mm.
If things are running really hard in terms of momentum, to look at things like quality as well as value, just to balance out the portfolio. And you can even diversify across time frames. I have my short-term bucket, my medium-term bucket, and my long-term bucket as well.
Macca, can you get options on every stock that you hold?
No. By far the most popular options are the index options, right? Options over the Australia 200 index.
Yeah.
But around 73 or 74 stocks have listed options. As a trader, I look for the more liquid ones, so I only really consider a universe of 30. But 70 plus of the top stocks have options available.
Yeah, so Macquarie would.
Oh, absolutely.
Yeah.
Oh, yeah.
I'm thinking I might need this. It's just done so well, that stock over the
A
last
great example, Peter.
years.
People who want to stick with it but have some safety could be looking at the options market.
Okay, well, no, I'm not doing any free advertising for Michael McCarthy, but the reality is,
I'm an advisor.
The bottom line is a lot of people do ask me about options, so it's a good reason to bring it up today. Guys, thanks for joining the program.
Thanks,
Thank you,
Pete.
Pete.
Julia Lee from Berman Investor and Michael McCarthy from CMC Markets. Well, JB Hi-Fi reported today, and a guy who's been watching JB Hi-Fi for a long time, and like me, liked JB Hi-Fi at $23 a year or so ago, has reported pretty well. Paul, what's the full story?
Look, a good report from JB Hi-Fi. Peter, for me, pretty much on expectation, but a little bit better in terms of net profit than the market hoped for. And the market's taken the share price up by a good 14% almost in the close. So it does show
What's
you.
it now?
Well, it's up towards $44. So it does show you that companies that are going to report well are going to get rewarded by the market. And I think that's the signs we've already seen so far in reporting season. Early days, but the market wants to buy stocks if you can deliver growth. And JB Hi-Fi's profit growth of almost 9% is respectable.
Yeah.
You know, the market's going to reward it.
But this 14%, is that short sellers also having to get it
Look,
out?
there still are some short sellers in JB Hi-Fi. I remember it was at $23, $22. I thought at $37 it was getting pretty expensive. It's now up near 44, Peter. I think the market is just so short of stocks that can grow. Short sellers are probably, again, there's still a bit of short selling in JB Hi-Fi. I mean, there's some good news for the company. One of the great things about JB Hi-Fi is it not only delivers sales growth, but its margin. That is, it's what it calls the cost of doing business. That's the money it spends on premises and rent and staff. It keeps on getting better at that. And actually, we saw, despite a bit of pressure on the actual operating margin, that's the difference between revenue versus the cost of goods, that it actually got its operating expenses lower, and so was able to improve earnings as on the back of sales increasing.
And have they done better with Good Guys? With Good Guys, was
Yeah,
the
Good
problem?
Guys has still been the bit of the struggling arm,
Yeah.
but Good Guys actually reported comparable store sales of 0.9%. That's a positive. Also reported improvement in earnings, so it also got its cost of doing business down. So as it sort of gets into the JB Hi-Fi way of doing things, it's becoming more efficient at the way it sells. Yeah. And so its overall earnings were up, and that was a positive as well. Also came out with a reasonably strong outlook in terms of how January started. So January sales data is up almost 6% compared to last year. That's positive. But did foreshadow that, and this I think we're seeing in retail, that it's going to get harder in terms of consumers are much more predisposed to chase sales. And also a lot of category sort of compression occurring. So that if anything, it did warn perhaps its margin in terms of difference between revenue and cost of goods might be under a little bit of pressure in the second half.
Well, a year or so ago, both you and I liked JB Hi-Fi because the market sort of really belted it down about $23, $24. At these levels, Paul, can you recommend JB Hi-Fi?
I'm not going to recommend JB Hi-Fi. I think just with the way the market is, if it's in your portfolio, you probably hang on. Because I said the same at $37. I said it was probably a sell. Yeah. It's now $44. It's a lot, 20% higher. So look, every stock has its price, but the market is in a very strong uptrend. There's a shortage of stocks that are able to consistently deliver. JB Hi-Fi delivers year after year after year. It's like CSL. It's the best retailer in Australia. Yep. The Amazon threat's still out there, but it's not really causing much damage.
They're kind of laughing at Amazon threat.
They're sort of laughing, and so would I buy JB Hi-Fi? No. If I had it in my portfolio, I'd probably hang on.
Yeah, me
and
too.
I still think it's Australia's best retailer. Yeah. And so if you are looking for a retail stock, maybe not at these levels, but and pullbacks is probably the stock you'd look at.
Yeah, and considering how hard retail is generally, Richard Murray must be one of the best CEOs in the country by a country mile.
Look, it has almost a CSL type record in terms, as I said, earnings up, sales up, profit up every half year, every year. It's got a great long-term chart. If he doesn't get the accolade for one of Australia's best CEOs, he's right up there because he really has delivered with that company, and it is firing still.
Yeah, without a doubt. That's Paul Rickard from the Switzer Report. If you want to get some inside information on some of the best companies in the country, he's the guy to read. Well, it's the start of another calendar year. January's out of the way. February, the market gets going in earnest, even though it was a great January, up 5%. But now we've got the coronavirus and all those other curveballs out there. But I want to know what someone like Michael Wayne from Medallion Financial Group is looking for this year, what stocks he likes. I also want him to comment on a couple of stocks that were darlings of the market in 2018 and copped it in 2019, namely Reliance, Worldwide Corporation and Speedcast. Michael, thanks for joining us.
No problem, thanks for having me.
Let's start with those dogs of last year, and it's interesting because if you look at the old strategy, the dogs of the Dow, you often do get the ones that performed badly last year and you go along them the year after and they happen to do well. These aren't classic dogs of the Dow because these aren't blue chips,
That's
are they?
right.
But still, they were darlings. Do you have a view on either Reliance, which is basically a worldwide plumbing business, isn't it? And Speedcast, which is like a
telecommunications company, primarily in that satellite.
Yeah, so I was going to say
space,
satellite
a bit
and
of a niche.
communications,
Look, I mean, I'm familiar with both of those
Yeah, of course
companies
you would
because
be.
they took off in 2018. We're getting a lot of attention in the media and in the press. Speedcast is actually one that we held for clients there for a period of time, and it's one of those ones that doesn't turn out for you. You don't get it right all the time.
So you got it right for a while.
Got it right for a while, and then it started to turn. But fortunately, we exited a while ago before the negative news continued to compound on itself. The update recently was probably the worst thing that could have happened to the business after 3 or 4 downgrades in the space of 12 months. The CEO has stood aside and resigned. Basically, the share price, I think, still in a voluntary suspension. And after a number of years where they went around and did a number of acquisitions, trying to incorporate those acquisitions into the business, didn't turn out as they would have hoped. And the problem for this company was that they took on a lot of debt to undertake those acquisitions, and they've got themselves into a situation now where they're having to potentially write off a lot of assets, sell down some non-core investments and some non-core assets in order to raise some cash to pay off that debt. So I don't think it's the right time to be jumping in, even if you are a bottom feeder.
Okay, so Speedcast, thumbs down. What about Reliance?
Yeah, look, Reliance was tempting there for a while. It was a business that was making big waves in the US. They were there for a while, a one-product business, but they too tried to diversify their business model somewhat into a number of other products. And they had some success there, but there is competition starting to emerge from some of the bigger players over there. They had some issues with the Brexit, which was disrupting the construction and building market in the UK. But we have seen some signs of a turnaround for that business. We've seen the Australian dollar come down a long way, which is a positive for that company considering they sell the vast majority of their stuff overseas. We've also seen a resolution to that Brexit. We've started to see some of the construction figures out of the US improve significantly. So if I had to pick between Reliance and Speedcast, I think the tailwinds are there for Reliance. But I wouldn't be jumping in just yet. I'll wait for this report to come out.
Yeah, and also my view on these sorts of companies is always, let's see the uptrend start. Even if you miss the first 5 or 10%, if the uptrend starts, it's going to be more than 5 or 10%.
Yeah, I agree. Like, you would rather pay that insurance, if you like, miss out on that 5-10% for that certainty. And particularly when you're in earnings season, all these companies coming out with their half-yearly reports, you might as well wait another week or two, see what these companies deliver before making your decision then. But at least you've got a lot more information in front of you that's up to date.
Okay, on the subject reporting season, JB Hi-Fi came out today. What do you think?
It's been an incredible turnaround for this business. Not necessarily a turnaround, but there certainly was a period of time where people were questioning these retailers, whether it was Harvey Norman, JB Hi-Fi.
Yeah, short sellers got it wrong, didn't they?
That's right. Amazon was meant to be coming into the Australian market and really disrupting these companies, and the best days were meant to be behind them. I must admit I haven't looked at the result in finer detail because it's not one that we own for clients.
Yeah.
But when you consider it wasn't that long ago, they were in the low 20s, now above $40. They can continue to roll out more stores and deliver on a strategy that served them well over a very long period of time. They basically have their model down pat. They don't have many overheads when it comes to warehousing. They keep most of their stock at floor level. And basically they've got the TVs. They've been able to jump on the back of some of the newer technologies as well as some of the older technologies phased out, such as CDs, records, videos, all that thing. So they definitely have some smart operators within that business.
Yeah, and I think Richard Murray's a very good CEO.
I think so.
Yeah, as results show. Yeah, we liked Ajiri Hi-Fi when the market knocked it down to 23, but current levels seem so high.
Yeah.
But this is a company that keeps on doing well, and I'm not going to be tipping it at these levels, but certainly I'm really glad to see it's done well. Now, what companies do you like for 2020?
Yeah, so basically, the last couple of years we've seen the healthcare sector and the IT sector be the best performing sectors over the last couple of years. And we would expect that thematic to continue because that is where the momentum is, that's where the growth is. When you look at sort of ageing populations, emerging middle classes, the demand for healthcare products, healthcare services is undeniably there. The same in the tech, no one can deny that technology is becoming a greater importance in everyone's lives. So we tend to focus our attention on those booming sectors.
Yeah.
So one of the stocks that we like at the moment, it's outside the ASX 300, but it's emerging as a successful business, is a company called Elmo. ELO is the code on that one. The business has been in operation since the early 2000s. There's a strong founder-led involvement still. So the two founders still own about 30-40% of the company. One of the founders is currently CEO. And they're involved in the payroll software space, as well as sort of HR resourcing as well. So any small, medium, large business is a potential customer for them. They do have some very large names as clients at the moment, universities for instance, the ATO, a number of large businesses, but their target market, from what the management have been saying, is that small to medium sized businesses between sort of 50 to 200 employees. And if you think about the Australian market, any company is really a target there. So they've done a very good job in building market share. They are the market leader in Australia. At the moment, they're not only winning new customers, but they're able to cross-sell other modules to their existing client base. And it's one to definitely keep an eye on. When you consider the tech space has run very hard, some of those more glamorous names have performed very, very well. This is a business with a software as a service business model that probably hasn't seen the share price appreciation of some of those other names.
Okay.
So that's one that we like. We still like companies like Aristocrat, which I think I mentioned on similar programs before. Things like Altium we continue to like. CSL, ResMed in the healthcare space. ResMed had a very good update just the other day. So we continue to like those good quality businesses, and I think investors can't get too nervous just because the share price might have moved higher. If the underlying fundamentals are supporting that and continuing to move in the right direction, there's no reason why you can't jump in now.
Okay, that's like the micro view on specific companies. What's your overall feeling for stocks for 2020? Are the positives outweighing the negatives, and therefore you want to be long stocks?
Look, I think the economic situation is improving. Looking at the economic numbers out of, say, the US, we've seen some stabilisation in China as well, coronavirus aside. You've obviously had the first phase of the trade negotiations agreed upon. You had the Brexit situation resolved after a number of years. So in many ways, the outlook is a bit clearer than it's been in maybe 3 to 6 months. So that should be a broad positive for equities. Often equities making all-time highs as well, historically is a bullish signal for markets, but you always have to be cautious and things can turn around very quickly. So although in the last 12 months equities have gone gangbusters around the world, if you look at equities over a 2-year period, it's far less impressive. I mean, global markets are up somewhere between sort of 5 and 10%.
Yeah.
So it's really only the last 12 months where things have really kicked off, but on a sort of 3, 4, 5-year basis, things are less impressive. So we still think there is value out there if you look at the right pockets, but you've got to maintain your focus on earnings and ensure that earnings are keeping up with the underlying share prices.
Yeah. Michael, thanks for joining us.
No problem, Peter. Thanks for having me.
That's Michael Wayne from Medallion Financial Group. I'm catching up with John McBain, the joint CEO and founder of Centuria Capital. You are a founder, weren't you?
Yeah, thank you, Eddie. Yes, that's got a long time ago.
Yeah, it is a long time ago, but you're still looking pretty young despite it all.
Well, thank you.
I might be biased.
I'm feeling it.
All right. I want you to explain, because some people have invested in Centuria buildings along the way, and you had a really good run. I can't remember the last rotten building you were involved in. Anyway, you would buy that. And then there's Centuria Capital, which is listed on the stock market. So you just explain so people understand the difference between Centuria Capital and those buildings that you invest with others.
Yeah, sure. That's a fair question. So we have a large number of unlisted trusts that operate. We manage them. As well as that, we have listed trusts, which there's an office listed trust, CMA, and an industrial listed trust, CIP. So people have a choice to invest in either generally a single asset.
So the unlisted one tends to be a single asset.
Tends to be,
Yeah, you recently
and then the listed ones are really, they each have a portfolio of assets, and they're getting quite large. They're both either 1.5 billion, something like that, getting relatively large. We've recently, 18 months ago, introduced another unlisted product, which is designed to be more liquid. So generally those single asset trusts are fixed terms, and they might be 5, 6 or 7 years.
Yeah, so people put their money in,
Correct.
they're a part owner effectively, 5 or 6 years, they get the rent along the way, and if it's selling at the end of a capital gain, you split it. And,
But what we noticed was happening was we're quite fussy what we buy, obviously, and people weren't like the unlisted concept. They like some people would rather invest in a REIT and a listed trust. Some people might prefer. A lot of people prefer unlisted. That's fine.
They can see the building.
They can see the building. They know which one it is. We've also introduced another product called our Centuria Diversified Trust. That's very popular. So in between times where we might not have bought an unlisted building, there might only be 3 or 4 buildings a year, they can invest in this diversified pool of properties, and that's got some liquidity, so they can enter into that.
A bit easier to get out once someone locks in for 5
years. It's not totally liquid. If there was a run of every single unit in the stock, there's rules, but it's certainly, we've never had that occur.
And so all the money made in either the listed or unlisted eventually ends up in
Correct,
and Centuria Capital, and that's the big listed stock.
Yeah, so that's the listed stock that I've always grumbled to is undervalued.
That's right. Until recent times.
Yes, till recent times, and
so people who listen to us might have done okay.
Well, if they hadn't sold their stock, I'd say they'd be extremely happy. That stock now has a market capitalisation of about 1.1 billion. Itself, it's CNI or Centuria Capital, so that's where all the management fees end up. We've just put out earnings per share guidance of 12.5 cents. It'll have a distribution of 9.7 cents, still a very good distribution. And its performance has been really good. Things, and like for example, the first 6 months of this financial year in our vehicles, in those managed vehicles we talked about earlier, they've bought 1.2 billion of assets. So that's lifted our funds under management in the whole group to 7 billion. And they're all good assets and we're very proud of them. But as the assets under control get greater, so the management fees that flow to the Centuria Capital business increase.
Yeah, because there's a small percentage on those, and they eventually end up being dollars in the headstock.
Yeah, and the principle with funds managers, we're a listed funds manager, so we're a pure funds manager. The principle is, of course, that if your revenues from management fees grow faster than your cost base, that should be very, very good for your security holders.
Yeah, okay. And you've recently moved into your homeland. I know you're an SKP from New Zealand.
Happy to be here.
But you've gone back home and bought something. Explain what it is and what impact that might have on Centuria Capital.
Yeah, that's very recent. So last week we announced a proposed takeover of a company called Augusta Capital in New Zealand. Actually, eerily similar to our business probably 7 or 8 years ago. It has a lot of unlisted trusts, a lot of very, very loyal investors. It also controls a listed trust as well as its unlisted trust. And all of its managed vehicles total up to just over 2 billion Kiwi, so about 1.9 billion Australian, and it's the same theory. We've got provided that bid proceeds and it's successful, and we believe it will be. That will take our funds under management in our whole entire group from about 7.1, 7.2 to roughly 9.1, 9.2 billion Australian real dollars.
Yeah.
So
You said that, not me.
yeah. So that's, and once again, very good business,
Yeah.
very well run,
Yeah.
very experienced, very good loyal investors. We think the New Zealand property market has a lot of similarities to the Australian one. I admit that some of the assets aren't quite as large, but we still think it's got quite good fundamentals. Certainly the land title system, the way they transact, the real estate agency system, it's very similar to ours. So we think it'll be good. We've got 36% of the shareholders have already agreed to support this bid. We've got, provided our bid is, as we've set out in our documentation, their board will support it. So we're hopeful it's going to be a relatively smooth transaction.
All right, so one thing a lot of people are wondering is that your sector, and you're basically, correct me if I'm wrong, you're in commercial buildings, you're in industrial buildings, and what else is a third area?
We have a health area.
Yeah,
So correct.
But the
Health-
commercial
health-
industrial is
healthcare
your-
real estate.
Yeah.
Yeah.
So the commercial industrial is your real bread and butter. Now, before I got to know you, there was a thing called the GFC, and a lot of REITs, and you're in the REIT space, really copped it because they carry too much debt and all that sort of stuff.
Yeah.
And it's been a great run ever since. And some people will be worrying, well, eventually, can this great run continue? Is the period of unbelievably low interest rates a part of the reason why you guys continue to do it? Apart from your own independent brilliance and picking good buildings and whatever, and the fact that the economy keeps growing, is it low interest rates a big plus for you guys?
Oh, undoubtedly it's a plus. However, we would argue we could make good profits from transacting in commercial industrial real estate, whatever the interest rate was. And we have done in the past.
Yeah.
The effect of the interest rates, funnily enough, it supports asset values, not just real estate asset values. You'll be aware a lot of our infrastructure, a lot of asset values around the globe is being supported by low interest rates, which incidentally, our and not that we're economists, it's very difficult for us to see what's going to put real upward pressure on those interest rates.
Yeah.
I'm sure it will happen at some time, but in the horizon that's foreseeable for a corporate, it's hard to see it. So I think the impact has been on supporting asset values, you're correct. Where the huge impact has been for funds managers like us, people have very low returns in their traditional cash safe havens. And your listeners and viewers will know that around 1%, not attractive, particularly if you're retired.
Yeah.
It's trying to find something that has a higher return, and I don't mean ridiculously high, but a higher return where you're not getting over gearing or you're not taking on too much risk or risks you don't understand. And that's one thing that we try and do when people are approaching us to invest with us. We're very keen to tell them what the positive things are, but and we've always been very keen to say, well, look, there are risks, and here they are. We don't gear our listed or unlisted products too highly. Certainly not like the old days. Neither do our competitors. We've all, I think with a unlisted trust, what might have been 60 or 65% gearing will now be 40 or 45%.
Okay. I know there's not a space you play in, but you might have in the past and I've forgotten. But retail property, all the challenges with retail. Is there any value in retail going forward?
The R word, yeah. We look. I think, firstly, we appear to have we might have the appearance of some brilliance by not ever being in retail, but frankly, we just never liked it. And when I say never, I'm not for 25 years. Certainly it's in difficulty at the moment, and I feel sorry for some of those guys. And I think there's a little bit more to shake out. We've got several of our friends own a lot of retail real estate and they do very well at it. I think regional retail seems to be doing better than some others. But I talked to some guys on the weekend, professionals, that good funds managers will find a way through their retail portfolios. They'll adaptively reuse parts of it. I just think it's unfortunate that rents have got quite warm and online has hurt a little bit, but we're not smug about it. We, as I said, it wasn't a predestined. We just never liked it.
Yeah.
You know, we're very happy with our office blocks, our industry, our industrial investments. Very happy with our healthcare investment we made, Centuria Heathley. And the only thing that the New Zealand business does in New Zealand, it's got involved with some tourism assets, hotels on long leases, which we haven't done in Australia, but I think it's quite exciting.
Yeah, provided the coronavirus doesn't go on for too
Well,
long.
or reach New Zealand in any great numbers.
Yeah,
you know.
right. I guess one last question to you, mate, is the outlook for investing in the kind of real estate assets you chase. What's the? You can't be necessarily 100% right, but what are you operating off?
Oh, look, and our strategy going forward is, we think our strategy period's really 24 months, then looking out for the third or fourth years. But over the next 24 months, we still find it very hard to believe, unless there's some black swan event, and I don't think the coronavirus is going to be that, incidentally, from what I've read about it. It's not multiplying logarithmically, and I think the world is responding better to it. It has to be some black swan event. We cannot see sovereigns suddenly writing off all the bad credit they've adopted, and we can't see interest rates going ridiculous. Now, while that happens, asset values will be stable. We're even predicting valuation increases on quite a few of the office and industrial portfolios, which we mightn't necessarily want, but I think it's coming. So, best for people to invest on fundamentals. Look, find a good manager, make sure they're not over-gearing their product, and invest in something. If it's going to be an unlisted syndicate, invest in something you feel comfortable with, and maybe do 2 or 3 investments rather than one. Yeah. Not that we're allowed to give advice, so my people in my office will be
just brilliant financial education.
Just the sort of advice you give your clients. We'll have so much in one sector, so much in another, so much unlisted, so much listed. I think that sounds wishy-washy, but I think that's the position we're in. I think the next 18 months to 24 months are going to be very positive.
I think it's good advice, particularly at this end of the cycle. You can take more risks at the beginning, but at the end, diversification is the best way. Even though Warren Buffett said diversification is for wimps, I'm a wimp when it comes to investing. John McBain, thanks for joining us.
Thanks, Peter.
John McBain, Joint CEO of Centuria Capital.